So Rick Santelli joins us now from Chicago with the Bond Report and an education for me here, too. Hi, Rick.
Hi, indeed, Courtney. You know, we've had a lot of volatility this week in Treasury yields, but I like my analogy about the roller coaster. You could have a lot of loop-de-loops, but you kind of get off right about where you get on. That's kind of like the Treasury market this week. A lot of volatility, but right now, if we were to close a 10-year at 414, it'll be up only 4 basis points on the week. A 2-year, also up about 4 basis points on the week. But what is really driving it? Today, it's all about stocks. Look at the S&P futures on top of 10-year note yields. And I picked the futures because they trade virtually 24 hours, so the charts match up nicely. They're right on top of each other. That explains it, but there's another force going on here. Think about how I always say debt and deficits matter. Well, let's look at one-month charts of all our counterparts in Europe. Let's look at the UK, the gilt yields. They're at 6-week highs. They closed. If you look at bond yields, they're at 1-month highs. And the reasons are easy. The UK has a £20 billion hole in their fiscal budget, and they don't know how to close it. They're talking about taxes, and a lot of moving parts. In the UK, well, France is basically in the same scenario. So there's a lot of issuance and debt areas that the market's focusing on. Now, you put up our 10-year for 1 month, you'll see that even though we're moving generally in that direction, we're still not at the highest yield close. We had those earlier in the month, but we are tracking some of that on the arbitrage. So there's this latent feeling in the Treasury market that yields are going to remain stubbornly high, but the equity markets do have their influence. When they get really sloppy, we go down. When they start to come back like today, we follow them right back up. Courtney, back to you.
Back up on that loop-de-loop. Rick, thank you so much.